Well, hi, I'm Byron Moore with Mike Jones. It's Monday afternoon, October the 3rd, and we've just finished one of the ugliest quarters that we can recall in a long time in the investment world. In fact, the whole year to date has been nothing to brag about for anybody when it comes to investments, both in the stock and the bond market. So we know that before long you'll be receiving investment statements and you'll be looking at them, and we thought we'd like to get ahead of that and give you some perspective on what you're about to see, but also what we see on a go-forward basis. Probably one of the best things to do, one of our common themes to all of our clients is that we need to be thinking long-term. And so the first chart that we're going to put up, and by the way, our charts today are made possible by the good folks at JP Morgan Asset Management. We appreciate them for producing these. This first chart is of the S&P 500 index over a 25-year period of time. And really the only thing I want to draw your attention to is the obvious fact that it goes up and it goes back down and it goes up and it goes back down. But over time, and this has been historically true, it has tended to go up. Now, it's not invariably so, and no one can promise that it will continue to go in that direction, but that certainly is the direction that all of history and all of economic information would seem to indicate that it continues to do. So while the last 3 months and the last 9 months, the 3 quarters of this year have been pretty ugly, we want you want you to know that we understand that's part of the price that we pay for being involved in markets. Probably the thing that has caused this market downturn, the one word that all of us could probably predict is responsible for it, is the word inflation. Inflation is something that everybody's talking about right now, but where does it come from? It's our belief that this most recent round of inflation is pretty clearly tied back to COVID-19 and the government's response to that. We're not saying the government response was good or bad. It just was what it was, which was a massive injection of capital into the system. And you can see by this chart of the Federal Reserve balance sheet on the upper right-hand side that it's just a massive increase in the amount of money that the Fed pumped into our economy. In fact, probably everyone watching this video remembers getting a deposit into their bank account of some amount of money or another, and that's one of the ways, just one of the ways that the Fed pumped an amazing amount of money into this economy to save us from a governmental and economic shutdown caused by COVID-19. Well, eventually that's going to have an impact, and so this next slide showing interest rates and inflation is a little bit of a busy slide, but notice that the blue interest rate line goes steadily downward from its peak in early 1980, and it goes down almost to the zero line there on the far right-hand side until it begins to spike back up again. And it spiked dramatically in the first, say, 3 quarters of this year, about over the last 1 year to 18-month period of time. And so, Mike, this rise in inflation has certainly had an impact on what the Fed does in response to that. So talk to us a little bit about the Fed, what they've recently done, and how that's impacted both the bond and the stock markets.
Okay. And the first thing I would say is for those out there who said, oh yeah, you could have seen that, you should have known, I could see this coming from a mile away. Interestingly enough, when 2008 and 2009 hit and there was that massive quantitative easing, there wasn't inflation.
That's right.
So we saw the Fed do this before, so we'll never know. We don't know where the true tipping points are. We know that they've occurred after they've occurred.
Right.
So tipping point, inflation, it came, it's here. At the very beginning stages, the Fed said it was it wasn't going to last very long, so they're not really doing anything. By the time it did last for a while, they were a little bit behind the 8 ball here, and in March of this year started raising interest rates. As interest rates go up, bond prices go down, at least on fixed coupon bonds. And so if you would look at the slide that shows the Fed and interest rates, this is the telling slide to tell you and show you why bond prices have had just a very poor year this year. If you see that going into 2022, interest rates were at practically zero for Fed funds. As of last Friday, they were hovering around 3.13%. And I might add that interest rates in the market for short-term instruments actually jumped higher than that. They're running around 4%. So we've never seen a time, ever, where interest rates as a percent of where they started went up as much as they have right now. Bond prices go down when interest rates go up. But one thing I'll point out before we leave this slide, both the green dotted line, which is the market's expectation for where interest rates are going to go from here, and the blue, which is the Fed's expectation of where interest rates are going to go from here. By the time you get to that hovering a little above 4%, notice how it goes maybe up a little, but then sideways and then possibly down a little over the next 2 to 3 years. That's significant, and I'll tell you why. We'll go to the next slide, because this shows the aggregate return for the bond market every year since 1976. Okay, so we've got close to 50 years of data here, and what you'll see is the annualized rate of return every year in the bond market, along with from any peak in the year how much there was a drawdown during that year, to on the far right side, Byron, do you notice something a little different about this one?
What I noticed is that there's a gray bar on the far right-hand side that goes way, way, way down.
It doesn't look anything like the almost 50 years before.
Correct.
So this has been a monumental year in a paradigm shift, a reset of interest rates, and therefore bond prices. Okay. Going back to the previous slide, though, it's not something that we are extrapolating out to happen over and over and over again. Okay. So think of it this way. For years, bond prices are doing this, and then they have a reset where they're down lower, and now we're going to earn higher interest on a lower value, and we're not going back up to where we started anytime soon, if ever again, but we can earn much more interest on the money that we have left available. It's just the reality of the day. And so, with that said, before we wrap up, of course, we have to address stocks.
Yes.
And stocks have always been more volatile than bonds. And many times when stocks go down, bonds go up, and they become your buffer for your portfolio. This year is that anomaly where that has not been the case. So as bonds went down and interest rates went up, all of a sudden investors are looking around and going, okay, there's a risky asset over here, riskier than bonds, that I've been paying X amount for. Now I can get bond interest, and let's just put it at 4%. I can get bond interest at 4%, or I can go buy a stock that's growing at, pick a number, 8% per year. All right, but it goes up and down in the market. Well, maybe I don't want so much of that. I'll go get some of this. So then stock prices come down, and all of that feeds into, well, will the Fed go too far? Will they put us in a recession? And that creates the uncertainty that makes the market discount. So to finalize and really think analytically, not emotionally, about the stock market. If you will look at this last slide that we have, it says corporate profits and sources of total return. And the market price is always going to be a multiple of the profits that it's earning. So it's really good to look out a couple of years ahead and say, okay, in a couple of years, what's the estimate for those earnings? And you'll see in blue this year, by the end of the year, we'll be about flat with last year, so not in bad news. Right. Next year, some growth. The next year, some growth. And so all I can say is if I do the math and I take that end of 24 earnings on the market times the multiple, the price to earnings multiple that we're trading at today, which is a reset from the beginning of the year because we have higher interest rates. If that holds its place, then you're looking at for the next 2 years and a quarter the potential certainly for double-digit returns on your stock market investor, for your stock market investor. All the reason to be excited as an investor going forward. Maybe not so happy looking at the latest statement.
Right.
Okay.
And so, speaking of which, as you get your statements, we want to address some comments to at least 3 different categories of people. Well, if you are 5 years or more from retirement, then really our message to you is that the portfolio that we've got you in, the portfolio that Mike looks at, reviews, and manages on a daily basis, is appropriate and is doing the job for you. Unless something has changed since the last time that we met with you, our message is stay the course. Mm-hmm. We don't have to like what we're going through, but we're not alarmed and needing to make massive changes. Mike manages the money and makes those changes within your portfolio constraints, but our message to you, if you're 5 years or more, is stay the course. Mm-hmm. If you're within 5 years, our message really hasn't changed either, and that is we should talk. We believe everyone within 5 years of retirement needs a tailor-made sort of a glide path into retirement. Because everyone's situation is so different, we want to not only work with your portfolio, but with some individualized strategies that are kind of customized just for you. And then if you're in retirement already, then our message to you and the immediate pre-retiree is we don't like everything that's just happened, but we actually like more things. We feel good about more things that have come about as a result of this reset and the higher interest rates that are now available to retirees and immediate pre-retirees than we ever have in a very, very long period of time. So we really think in a lot of ways the message is good news.
Yeah, Byron, it has been a terrible season for conservative and moderate conservative investors to get yield since the financial crisis. Yes. So we're in a new regime now, and all of a sudden those investors, the toolbox with which we can go to has gotten so much bigger. Right. So it is an exciting time from that perspective.
That's good. So again, we'll just close today by saying when you get your statement, we don't expect you to like it if your numbers are, and they likely will be lower than what they were the last time, but we do want you to have perspective that we are certainly not panicking. In fact, in a lot of ways, we're seeing a lot of good in the near-term future, especially for those that are benefiting from higher interest rates. So thanks for letting us have the privilege of serving you. If anything has changed, if you want to talk with us, we are here, a phone call away. We certainly will stay in touch with you by regular means, but you are always welcome and invited to call us if you have any questions. So for now, that's Mike and Byron. We appreciate the honor and the privilege you give us of serving you as fiduciaries. So thank you very much.
Thank you.